Okay. So today we're going to be covering one of our a fundamental training, which is part of our 7 fundamentals that we need to master, right? And one being mastering the products. That product being life insurance. Okay. When you, I always tell people uh, that there's nobody more knowledgeable when it comes to life insurance and investment than a Primerica, a person who mastered Primerica. Okay, not just because you're here, you're gonna be better, but if you master this stuff, you're gonna be way better than anyone out there. We are not life insurance agents. We are not life insurance agents, but if you go toe to toe, I wouldn't recommend it. But if that ever happened with another life insurance agent, trust me that you'll be a lot better. You'll know a lot more, given that you master this. So this is very important. It's very important that we master this, and so that's why I'm going to cover life insurance and how it's built up and all of that. Bethany or Trevor, do me a favor, post something in the Telegram. All right, so and excuse my throat is. I've been talking so much that my throat is kind of raspy. All right, so today's training is going to be life insurance 101. All right. One of the products that you better master is life insurance. Okay. The one product that most people are being taken advantage out there. Okay. One product that everyone needs, not a lot of people understands, and the industry, especially life insurance agents, they use confusion tactics to put people in the wrong products. All right. So, but before we actually dive into the actual the actual training, sorry, I want to go over a very foundational concept, right, of part of life insurance or part of your personal finances, and it's how to become financially bulletproof. Okay, the theory of decreasing responsibility. So when we are younger, okay, as when we're younger, naturally we're gonna have a lot less responsibilities. Okay, because we are young, we have gonna have young kids. Uh, Correction, let me take it back. I think I said less responsibility, a lot more responsibilities, a lot more responsibilities. Okay, because we're gonna have young kids, we're gonna have more debt, you're gonna have mortgage, you're gonna have it just more responsibilities. Also, in this stage of your life, okay, unless you were born to wealth, majority of us are not going to have that much money saved. So in the early years, the loss of income, all right, God forbid something happens to you and you can't provide for your family, obviously you pass, right? If the loss of income will be devastating for your family. For this reason, in the early years, we need a lot of coverage on life insurance. Now, as time progresses, and this this uh this right here makes basically showing like the time, right? We went from being young to being old. As time progresses and we reach the age of retirement, okay, at this stage of your life, you're gonna have a lot less responsibilities. Um, I actually jump ahead. I had something else planned, but I'm gonna do this, and then we'll close down with a little bit of education. All right. From now on, we're gonna open up with we used to call this CANI, constant and never-ending improvement. So a little bit of personal education. I'll close with that. But from now on, we're gonna open. All right. So in this stage, a lot less responsibility because now your kids are grown. You should have very little debt, if any, and you should not have mortgage at retirement. But what you do need here, you need is retirement income. You need money for retirement. So in the later years, you better have a lot of money saved because that's where you're going to live from. This is where the moment you stop working, this is where money's going to come from your retirement savings, your retirement investments. Also, in the later years, you may not need life insurance. The reality is the moment blue is money and green is insurance. The moment your money accumulates to the amount of insurance that you need protection for, right? From that point on, after that, you're gonna be self-insured. So you may not need insurance. You may want it, but you may not need it. So what do we recommend? Remember that we're not an insurance company. So insurance companies, they want to keep you as their client for their whole time, their whole life, for your whole life. We don't want that. We want you to, get you debt free and financially independent. So we're gonna say, hey, why don't we just cancel this policy? And the money you were investing towards that policy, let's put it towards your retirement savings. So you can either retire a little bit sooner, or you can retire with a little more money. Make sense? All right. So now that you have both life insurance in place and retirement, in place, all right, your family is good because you now have protection, right? God forbid you die sooner, your family's protected because you have life insurance. But most people don't die. Most people, 85% of people make it to retirement. So you'll be taken care of because you prepare for retirement. You have retirement uh, investments. Okay? Simple, very good. Okay.
Hey, Coach, can I just give my own personal example on that real
Yeah.
quick?
Yeah.
So as an example, my mom, when I got into this business, we did her analysis and everything like that, and we saw that she had enough money in savings and investments uh, for what her purpose was when she passes, but she was also carrying a life insurance policy to cover that same thing. So what we coached her on was to stop that life insurance policy and invest that money so it's working better for her now while she's still here, since she was already financially independent and had everything taken care of.
Yeah. And again, because people work with companies out there who push products, okay? Every company, with the exception of Primerica, just so you know, push products, okay? If they're a life insurance a company, they're gonna try to put you in that one product that makes the most money for the company and for the agent, regardless of your needs. They don't care about your debt. They don't care about you retiring, okay? That's how that works. If you sit down with with an investment company directly, well, number one is all investment companies outside of America, they're going to require a minimum amount, usually a steep amount. Could be 25,000, 50,000, in some cases, even in the hundreds of thousands, depending on the company. Most people don't have that. In our communities, most of us, we don't have that much money. So that's why most people are not really taking advantage of real investments. So what are people doing these days? They're buying crypto, they're investing in these apps where you can invest your money, supposedly in real investments, but they don't perform well. They don't. So very good. But thank you for that, Trevor. Let me see. Absolutely. Okay. So yeah, so that's how it works. Now, let me go over the importance of life insurance. Okay, again, this is one of the things we do is we educate families, right? And you're gonna see that a lot of people are either miseducated because they trust what they hear on social media, which, by the way, let me tell you, being an expert in finance and this, every day I want to message somebody or rant on some, but number one, it's not professional. Number two, it's not, because we're security, especially us securities license, we can get in trouble for doing that. So that's why I just let it be. But I really wish I could, because oh man, how many lies and how many it's a lot of misinformation, a lot of bad information, and a lot of misleading information. Okay. So, but with education, when you know better, you can do better. Okay, with education, you can make educated decisions. Okay, so that's why we focus on education. We take an educational approach to finance. No other company do this. All right, you sit down with them. Trevor, how much insurance you need? How much can you afford? That's how they sell it. They're not telling you why you need it, how much you need, blah blah. Blah. Okay, so anyway, enough of my rant this morning. So life insurance is meant to replace. It's the purpose of life insurance is to replace your income. God forbid, a breadwinner dies. Okay, and that's why we call it income protection, because it protects your income. It doesn't protect your life. God forbid, life. No life insurance can protect you. Okay, so here's an example of a couple that they each work. So they each brought money towards the household. When someone depends on your income, you have you must have life insurance. Unless you have, say, if you already have a lot of money accumulated, you don't need any life insurance. But in the time being, we use the term you rent money with life insurance until you can accumulate your own money. All right, that's how that works. So here we have dad, mom and dad. Okay, let's say dad on his way to work, he gets into an accident. He's a young guy. Okay, he's not thinking he's gonna die, right? All young people think they're never gonna die. We never know, right? But dad on his way to work, he gets into a car accident and he's killed. Other than losing dad, what did his family just lost? Well, the income. Okay, so now we have mom with half of the household income trying to pay for the monthly expenses that we know it's impossible. So what's going to happen? They're going to slowly lose it all. All right, I can tell you, I've seen this happen a few times, and doesn't end well. I know of a family who ended up having to move. They lost the house, and they ended up having to move to lower, no, not low income housing, but a lower income area. So switch the kids' schools to usually lower income areas. The schools are not great. The environment is not that great. It was a very bad situation. Not only they were already suffering a lot because they lost dad, all of that happened to them in a short period of time, and it was very bad. Okay,
Yeah, the whole standard of life changes.
absolutely, absolutely. And it's just that you can go from a decent neighborhood and be put in that. It's not good for you and the kids. Okay, so this all could have been prevented if they had life insurance. Okay, so experts recommend that we have 10 times, at least 10 times our annual income in insurance. So his income was 3,500 per month. If you multiply that times 12, that's $42,000 a year. And if you multiply that times 10, that's $420,000 that they each need in insurance. And again, if they had $420,000 invested, they wouldn't need insurance. Okay. Now, the only kind of life insurance we should all have is level term life insurance. Why? Because you can get a lot more coverage for less, and it does exactly what it's meant to do. Not like the other policies they sell out there that they tell you they do something and they tell you one thing and they do other things. Okay, we'll go over those today too. We'll go over those today. Okay. Now let's say mom dad had a life insurance, and the life insurance company cut a check for 420,000. Okay. If mom takes that check and deposits it in her account, okay, just like lottery winners, people that don't know how to handle a large amounts of money, they don't know how to handle it. So we just know what's going to happen in a couple of years. Okay. Uh, Something's going to break at the house. Um, Maybe she's gonna get the what is it called? The mommy makeover, I think it's called mommy makeover. Uh, then the when there's money, the relatives show up, because money's relative. There's always friends and people. Then you're gonna feel bad all of what I'm saying is in a couple of years, the money's gonna be gone. Okay. So, but again, that's not the purpose of this money. This money is meant to replace that income. So what needs to be done? That money needs to be invested. Okay. And we're gonna tell the investment company, send mom 10% of the interest, which is 42,000. But don't send it all at once. Don't send it in one check divided by 12 so that she can get a monthly check of 3,500, which replace that income right away and everything continue. So obviously they're still gonna they're gonna be suffering emotionally. I mean, that passed away. But financially everything continues. So that this didn't make everything worse. Okay. This family is left to mourn the way it should be. Okay. So that's the purpose of life insurance. And again, you're gonna see out there people talking all kinds of crap. All right. One of the things you're gonna hear out there, they're gonna be everything they push. Remember this, and this is in general in the financial services industry. It could be the same in everything. I don't know other industries. Okay. They always, oh, Trevor, you might be able to say if they do the same in the car industry because you used to be in that. But in the financial services industry, they're always going to try to put you in the product that makes them the most money, regardless. Regardless. Okay. Now that you're educated, that won't happen to you. Okay. So that alone, I tell people that alone, man, that it makes for that reason alone, it makes total difference, total a big reason why being in this business. Because the financial education you're gonna get, you're not gonna get it anywhere. Okay. So one of the products they like to push is called cash value. Okay, so there's two types of insurance. Okay, there's insurance with savings and insurance, plain insurance, just like car insurance, uh, even cell phones, even cell phones have insurance these days. Home insurance, all insurance, none of the insurance comes with savings. But when it comes to life insurance, there is a product that comes with that. That product is called cash value. Okay. Plain insurance is just term insurance. Okay. Now, cash value comes in different forms: whole life, universal life, variable life, and the most common these days, the index universal life. That's what you're going to see a lot and hear a lot. Okay. So when you see that everyone's pushing one kind of product, that should tell you that that's probably the product that makes the most money for them right now, for life insurance agents, especially. Okay. No, no financial advisor will push this. Okay. None of them. When a person is fully licensed, I mean they have insurance and investments, they're never going to push this product, those products. Okay. Now, how does it work? Okay. You pay a monthly premium to the company, 25 to 25. From that monthly premium, that's gonna cover two things. Okay, it's gonna part of your money is gonna go towards the face amount of the insurance, the protection, the insurance, and part of the money is gonna go towards the cash value, the savings. Okay, so the life insurance portion, the face amount, the protection is easy. Okay, you pay if you're paying a monthly amount while you're paying it, it's you're good, you cover it. That's easy to understand. Okay, now where it's not easy to understand is the cash value. Even if you read the fine print, it's extremely difficult to read it. Okay, we're going to teach you to read that. We're going to teach you to decode this policy. So you and a loved one and nobody in your community is being taken advantage. Okay, so how does the cash value works? So I want you to imagine that you walk into a bank and you're going to open a savings account. And let's say out of the 225, to be fair, okay, let's say $50 is going to go towards the cash value. We know it's not, it doesn't work like that. But let's say it's $50. So imagine you walk into the bank and you tell them, "Hey, teller, I want to put $50 per month into a savings account." Okay. Once you do that, they tell you, do me a favor, I want you to sign this contract. And the contract says, Mr. or Mrs. Client, for the next year to 3 years, you are not allowed to come back to take any money out because your account will remain at zero. And then they tell you, Mr. or Mrs. Client, once your accounts start to grow, it's going to be growing at a 1 to 4% rate of return, which is very low. Then they tell you, oh, Mr. or Mrs. Client, if you ever need money out of your account, money that you put in, your money, well, you're going to have to borrow it. The term borrowing should tell you that you're not an owner, okay? And you borrow it, and then you have to pay us interest at a 6 to 8%. It's all in the policies, in the contract. Well, and then you tell them, then you might be thoughtful, like you might think, like, hold on, you pay me 1 to 4 to make my money grow, but if I use my money, I gotta pay you 6 to 8, and they say yes, that's exactly how it works. At this point, will you open this account? Will you sign the contract? Absolutely not. Well, it gets worse. God forbid you die. Your mom, your beneficiaries, your loved one will only get the cash value. Whatever's accumulated here, the company keeps. And even worse, let's say you had borrowed money. They're gonna reduce the face amount by the amount you borrow minus interest owed. If you owe them interest, they'll also deduct it. So here's the thing. And like I said, they keep the cash value. So you pay for two things. All right, look, let's make it even insignificant. Let's say you go to Burger King and I don't even know what a meal costs. Let's say $5. I don't know. Well, you pay them for a meal, which is a hamburger and fries. And you go through the drive-thru, right? And you open the bag and all you see is a hamburger. What's the first thing you're gonna do? You're gonna drive right around and you're gonna walk in. All right. Obviously, you pay for two things. You expect the things. But in this product, it doesn't work like that. They don't explain it like that though. So it's not that people are buying these products and uh, they're fools. It's just that they're being fooled. That's what it is. Now, the right way of doing it is the same $225 will buy you a lot more coverage in term insurance. Okay. So this for the same cost of insurance, you can get $250,000 in insurance. And here's the other part. You should never invest with an insurance company. They're not an investment company. So you should separate that and invest with an investment company, which we're going to invest in mutual funds. Okay? Because it's invested in mutual funds, your money is going to start to grow immediately. You're going to be earning 9% or higher rate of return. If you need to use your money, you don't have to borrow. It's your money. Why do you have to borrow? It just doesn't make sense. You take it. And God forbid you die, your family gets both the death benefit, all right, and whatever's accumulated here. So here's the dumb question, or here's the obvious question, right? If it was presented like this, which one will you pick, A or B? Everyone says B.
Of course, be here.
Absolutely. But here's the thing. Why do you think 89% of policies sold each year are and in force right now are cash value? Because they lie.
It makes the company more money, probably. That's why.
It makes them more money. Plus, it's not presented like that. They use their tactics. They'll omit information. They'll they'll use intimidation, like hey, don't put your money there. You can lose it all. They'll use tactics to put you in this product. This is safe. This is for sure guaranteed. They'll use those words that are not necessarily um, true. Okay, they're. I'm not saying they're necessarily lying. In some cases, they might not be lying. They do lie, by the way. But in some cases, they just omit information or they'll bend the information. Okay. Now that you understand how this works, let me go over a couple things. Okay. Everything in the industry is always a fad. Okay. There's always been a fad. All right. Back in the 70s, whole life was actually not in the 70s. From the early 1900s all the way to the 70s, whole life was the one product. So back then it was only two. It was term and whole life. That's it. It was nothing else. Well, then in 1977, Primerica was founded to correct the injustices. Okay, so for the newer people, before Primerica was founded, okay, Primerica's founder, to make the story, long story short, he learned that his dad, when his dad died, he learned that his dad was sold a whole life insurance policy, which only had $10,000 in coverage, when he could have been sold a term policy for 10 times more coverage for the same cost. Obviously, the life insurance agent did it for his benefit. But once he learned that, he went ballistic. He studied a lot. I guess he was a very driven guy, and he is. Okay. So what he did is he started recruiting people to start a new company. And eventually they did. And all they did back then was educate, don't buy, everyone had a whole life back then. And he will educate him on why they needed term. And he started replacing that stuff. He started replacing the term. By the way, all of these companies, even companies that sell whole life, they sell term. The problem is that because term doesn't pay them, to be honest, if they only sold term insurance, they wouldn't be able to stay, afloat, the company, because it doesn't really make that much money to the company. Okay. And because they spend so much money in advertisements, and they spend a lot of money to accrue a new client, to get a new client. So it doesn't mathematically, it's impossible for them to do it. That's the reason why they push those products. So Primerica started replacing all of those whole life insurance policies with term. And because that started happening, the new fad came, okay, which is universal life. And a universal life is a policy that has still cash value, but they have products that look like investments. So they were telling people, hey, no, this is insurance plus investments, but they're not really investments. And you're going to learn that today. All right. We kept working, and they had to come with something a little bit better. And they came out with variable universal life, which this is actually an investment, but a very poor investment. The savings portion of the variable universal life is an actual investment. Okay. Now, then came again, people started learning about term, so those policies came up with a product which is called return of premium term. Return of premium should tell you how it works, or at least give you an idea. So people are overpaying supposedly for savings inside the term, and at the end of your policy, at the end of the term, they'll return the premium to you. But it's garbage, because what it does is, let's say you're paying $10 for a $5 sandwich, and out of the $5 that you're overpaying, you're gonna get $2 back. That's no business, but they don't present it like that, guys. All right, and then UL term came out, and whole life came back again. And again, it doesn't compete with us. So now the new fad is index universal life. So we're gonna spend a little bit of time on index universal life. but we're gonna present them all because you need to know how they all work. Okay. And the first policy we're gonna talk about is a whole life. Okay. Basically, how a whole life works is there's two components to it. Okay. A whole life is composed of a decreasing term. So there's term insurance inside of this policy, only that it's transparent to the consumer. The consumer doesn't know that. So it has a decreasing term to age 100. And the way that the decreasing term works is basically it's a level. The premiums are level. They stay the same. They never change, but the face amount drops, the coverage every year. It keeps dropping. Okay. And it also has the cash value portion, which is invested in treasury and government bonds. If you're not too familiar with those are very safe investment products, but they just get very low interest rate, very, very low interest rate. Okay, your money's not really growing there. All right, so here's how the decreasing terms work. Again, it's a face amount. The premium is level. So as the client age, the coverage decreases. Okay, so you be able to see how that drops. Okay, eventually at 100, the term ends. From that point on, the person doesn't have any more insurance. Okay, so a whole life, yeah.
If I can just to add on to that, the reason why it decreases like that is because technically every year the cost of that coverage actually goes up, right? So since you're not paying that higher premium, that's why the face value decreases. So it actually sells itself out.
Yeah, that's a great point. The cost of insurance is based on two things: your health and your age. Okay, so nobody gets better with age. Nobody, it's just naturally our bodies are not conditioned to get better with time. So the mortality rate, the chances of you dying go up as you age, obviously. Okay. So yeah, that's how the decreasing terms work. Okay, so this is how it looks inside of a whole life policy. So again, the in a in a whole life policy, it's a level premium. The premiums never actually premium I was showing here. It's a level premium. The premiums never change. All right. And the face amount never changes. The face amount stays the same. All right. Now here's how this works. At the beginning of the policy here, the company carries all the responsibility, all the risk. Okay, because this is a higher risk. Because if you die here, the company has to pay 100% of the face amount. Okay. Now, as time progresses, let's say the person dies here at 65. All right. If the client dies here at 65, the cash value will be 49.1, but let's say 50,000. And the company, the family will always get 100,000, the face amount, minus any borrow amount. Okay. So that means the company only had to pay $50,000 out of their pocket. So they're shifting their responsibility as time progresses. Isn't that something? Isn't that something? You're paying a company so much money, and they're basically, this is, anyway, I don't want to get into rants. All right. Now, obviously, as time progresses, it's even worse. If they die here, 75K will be in the cash value. Company will still get 100,000. So the company only pays out of pocket $25,000. Okay. All right. So what are experts saying about this kind of policy? Let me make sure I got the sound right.
Michelle's in Georgia. Dave, I was surprised when another insurance agent told me that in your book you admitted to having whole life insurance in your portfolio. The insurance agent lied. Michelle, I didn't say that in my book. I admitted that when I was in my early 20s that a goober from college came and sold us a whole life policy, and I was so stupid I bought it, but I canceled it once I learned mathematics. What a scumburger. His belief that it would help you reduce taxes. I had asked that if you still had it, and that was unknown. Because I sell life insurance, I want to do right by my customers. Is there a condition that someone should have a whole life policy? If so, why? No, there is not. Whole life insurance, cash value life insurance, is the payday lender of the middle class. I've been screwing the middle class for decades. No one sells whole life insurance except insurance people. No one believes in it in the financial planning arena that doesn't sell it. All the independent thinkers and all the people who do financial planning based on numbers and mathematics believe whole life is a ripoff and don't sell it. The only people who tell you it's a good idea are people who sell it. That's a pretty sucky record, really, if you think about it. And this guy is a straight-up freaking liar. No, I did not say in my book I had whole life insurance for tax advantages. I've written a bunch of books, and I really do know what's in them because I really wrote them. And it's just simply not in there. This guy's a bonehead liar, and you really should avoid doing any transactions with him. As far as whether you should sell whole life, absolutely not. There's only two kinds of people that sell whole life insurance. There are those that know that it's a ripoff and therefore they're crooks, and there are those that are too stupid to understand the mathematics and they still continue to sell it, or they've just kept their head in the sand and refused to look at the mathematics. The mathematics are pretty simple. Whole life insurance is roughly 100 times more expensive. So it's 20 times more expensive, I'm sorry. So about $100 a month buys you the same amount of whole life insurance that $5 a month buys you in term insurance. What does the other $95 go to? Since you're being charged $100 instead of $5 for the same amount of insurance. It goes to build up a cash value inside the policy, which for the first 3 years is zero. What do you call that? Front-loaded heavy commissions. I mean, if it's a $100 a month premium, that means that they are collecting almost $4,000 worth of commissions before you make a dime. I don't think so. And their commission's 100% of your savings for the first 3 years. Look at a whole life policy. Look at the cash value buildup. 0, 0, 0 first 3 years. That's horrible, you guys. That's not a difference of opinion about, a few percentage points in how a mutual fund is charged. A mutual fund charges 5.75% for the ones that do charge commission. These guys charge 100% for the first 3 years. It's unbelievable. It's unconscionable. And then once you do start actually having a cash value, then you can calculate the rate of return on your money because we know what the insurance costs because we can compare it to term. Term covers the cost of the insurance. So we can figure out you got $95 going in, and then we can watch it grow and put that into a financial calculator, and we can back out the actual yield. Those of us who know how to do, a financial transaction with financial calculator. Here's what you'll find. The average cash value policy will yield you, net of all expenses, 1.2% on a whole life policy, 3.6% on a universal policy, and 4.3% net of all expenses. Now, they'll quote you 10 and 12 and all this other crap on a variable life. And so it's a horrible rate of return for long-term investing. Absolutely horrendous rate of return on long-term investing. Oh, And then when you do build up the cash value, if you have a $200,000 whole life policy and you end up with $50,000 in there after you get past those zeros and the horrible rate of return, and you finally end up with $50,000 in your $200,000 cash value policy and you die, you know what they send to the beneficiary? $200,000. The amount of the insurance. What happened to your investment? Well, they keep it. So you have a savings account where the first 3 years they keep all your money. After that, they pay you 1%. And after that, when you die, they keep your money. This is a horrible savings account. It's a payday lender of the middle class. It's absolutely ludicrous. So, no, I wouldn't sell that stuff to anybody. I wouldn't even sell that to an enemy. I wouldn't want my name attached to the lack of integrity of selling a product like that. And if you're a whole life insurance agent and that pisses you off, good. Because I'm a consumer advocate. I'm not here for you. I'm here for my listeners and what takes care of them and what serves them. And I've consistently said this on the air since the first day I turned on this microphone. I have never wavered from it one time. And I certainly didn't say in one of my books, you slime ball, that I own this garbage. Unbelievable. Unbelievable. So, no. Don't sell whole life. You shouldn't sell whole life. Don't own whole life. You should always buy term life insurance for $5 instead of $100. Do your investing anywhere else. Crap, if you put it in a fruit jar, you'll end up with more money when you die than these people. Because at least it'll still be there.
Anyway, guys, so like I was saying, they'll say whatever they need to say, okay? But you now know, okay? And by the way, all life insurance are sold with a contract, okay? So it's not it's not, what's the word? It's not a naysay. It's not oh, I believe. No, it's a contract. Okay, they can take you to court because it's on a contract. All right. So that's how it works out there. You're gonna find people and they believe in those products because they were sold, and a lot of times sometimes it's even their own friends, their own family members, and it's that's why, hey, we'll teach you how to talk to people, present the information so that people don't get razzle dazzle, whatever, when it comes to that stuff. Okay. All right. So the other next one we're going to talk about, which again, this is the most common, the one that you're going to see the most right now. And if you go on social media, especially, well, I know I see it a lot in TikTok, but you know how the algorithms work. If you see something, they'll start showing you the same thing over and over. So I get shown a lot of this IUL, index universal life policies, and how they sell it. So you're gonna hear people saying, "Oh, this is tax-free savings." Well, number one, it's not tax-free savings. Okay, the government only allows certain types of investment accounts or types of accounts that are tax-free, really tax-free. Okay, which is a Roth IRA. There's some municipal bond funds, or some municipal bonds, etc. Everything else pay taxes. So if they tell you there's tax-free savings, the reason why you don't pay taxes is because here's how money works in general. If you invest $100 and at the end of the account you have 95, that's considered a loss. So you don't have to pay money on a loss. And because this policy, you're guaranteed to be at a loss, they always call it a tax-free savings. It just doesn't make sense. The second thing that they'll call this kind of money is that it's protection on your investment. So it's money protected. Okay. So in index universal life, the money gets invested and there's a floor, meaning that it will not ever go below zero. But there's also cap. There's also a ceiling. Okay. So, which sounds great, you know, in the surface, right? But it doesn't work exactly how they promote it, right? You're also gonna hear it like be your own bank, infinite banking. Uh, they will also say they love to say that I've seen this is exactly how the wealthy made their wealth. That's crap. That's crap. Okay. Again, they will say whatever they need to say to make this product sound attractive, but you're not gonna be taken advantage. So what's in a universal life? There's three components to it. The again, all of these products have term insurance inside the products. So why you don't get term on yourself? And you're basically going to a middle person. Okay, imagine you come to me to get term, which I'm gonna have to buy from someone else. Every time there's a middle person, there's additional cost, right or wrong. So term, they all have term inside the policy. So this one has an annual renewable term. I forgot to actually, you know what? I forgot. I have a handout for today's training, and I forgot to send it. I'll send it at the end of the training. But everything that I'm covering, some good notes there, and I want you to keep those handouts. That should be on your computer and your iPad. Have it with you so you know exactly what what you're seeing. Okay, how does the annual renewable term works? A quick preface, okay? Always called annual renewable term, but it's not always annual. Just make it okay. Just it should be called renewable term. You're gonna find policies that renew every 5 years. Okay, but okay, ART. How do they work? The face amount stays the same. Remember what Trevor said at the beginning? The cost of insurance goes up. So if the protection stays the same, what do you think is happening inside? The cost is going to go up. So that's what's happening. The face amount stays level and the premium increases yearly. In this index universal life, there's several fees and they're extreme amount of fees, cost of fees. Okay. And they also have the cash value portion, the savings. Okay. So here's a graph that kind of shows you how that goes up. It goes up every year, but it's not. It doesn't really go up gradually. It's not like certain amount percent per year. Okay. In the early years, it grows up. It goes up very slowly because your mortality rate is lower. Like the chances of you dying are lower. But towards the end, it's like this. It goes up like a roller coaster. Okay. All right. So that's how it works. Now, I try to make a graph to make this the easiest to understand as possible. Okay. So if there's some confusion, please let me know. I want to make sure that this is very easily understood. Okay. Again, I talked about the premiums are level. So this is the premium, right? By the way, I took all of these numbers from a policy, an example policy. We have policies that we can show you later. But so this person was paying $250 per month. All right. And started investing or started this policy at the age of 36. Okay. The cost of insurance at the age of 36 is $29.25. Okay. 10 years later, the cost of insurance is $66.75. Okay. Very quickly, you can see something that, if to me, it doesn't make sense. Okay. So if I buy this kind of policy for the purposes of investments, why are you charging me more in insurance? Meaning that I'm saving less and less per year. Make sense so far? So as the cost of insurance goes up, you save less and less. So that right there is a red flag. Obviously, guys, people don't understand that. Those policies are very confusing. They're purposely done that way. 10 more years, then now the cost is $162 per month. Okay. 10 more years, 444. Now, this is what happens now. You notice how it went past the cost of premium, the monthly premiums. Now the costs are more than the monthly premiums. When that happens, your premiums are not covering the cost of insurance. So the company is going to start deducting the premiums from your cash value without your consent. They don't need to ask you because it's in the contract and it says that they have the right to do that. Now, even worse, and this is where when I understood that it got me, not only that they're taking their premiums out of the cash value, they take it out in a form of a loan. So you're also paying interest. Isn't that crazy? That is, boy, I tell you, I really get heated, guys.
That's dirty, coach. That's dirty.
I really get heated. I've had actually agent confrontation when, especially at the beginning of my career, when I used to be very emotional about this. I was up face to face with a person who sells this, and I almost this. I've matured a lot, guys. Okay, but I almost put my hands on this guy. Okay, all right, and then obviously the cost of insurance is just skyrockets. Okay, it goes to $1,161 per month. Okay, so what does that do to your cash value? Remember how we said that for the first year, your cash value stays at zero? Well, in this policy, it was like 4 years later when the cash value started to accrue. And the way it works, starts going up. All of a sudden, it goes like a roller coaster. It goes down like crazy fast. Okay, and when the cash drops to zero, the moment the cash value is at zero, it terminates the policy. The policy lapses. So you might say, shoot, didn't I pay for two things? Insurance and savings. Why, when my cash value goes to zero, you're terminating my insurance? I have been paying to this. You know what they're gonna say? It's in the contract. Now here's how it works. Here's the cash value. This is the real numbers of this policy. Okay. In the early years, the first 4 years it was at zero, like I explained, but you see that it starts to grow. Now pay attention to the growth. It's not really like something substantial. It's very slow. You've been paying, or this person has been paying into this policy for 5 years, yet only has $1,500. By the way, that's not a rate of return of 1 or 2. It's in the negative rate of return. It's at like a negative 400%. Eventually, when we get here, now the cost of insurance is more, again, it starts to go down. And you notice here how it drops, okay? It starts to drop slowly, but at one point it's extremely fast. It's like a reverse snowball, like a negative snowball. Like your money goes quicker and they're just stealing your money. That's how all of those policies, all the universal lives, that's how they work. Variable life, that's how they work. Okay, so there isn't such thing as a good cash value policy. In all cases, it's bad for the consumer. The math is, like I always tell people, the math is math. You can never tell me when something doesn't add up. Okay, now something to learn. These policies are always offered with two options. And you'll see it either way. You'll either see it with option A and B or option 1 and 2. Option A or 1 means basically this is the standard one. When you buy that one, it's a cheaper one, and if the client dies, the company keeps the cash value. Option B or 2, the beneficiary gets both the death benefit plus the cash value. But the important part there is there's an extra cost to that. So it goes kind of like what I said earlier, that you pay $10 for a $5 sandwich only to get $2 back out of the $5 that you overspent. So they make a fool of a person even worse. when they buy this. Okay, I have another video to show you what experts are saying about this.
Go to Kelly in Missouri. You are on the Susie Orman Show.
Hi, Susie.
Hi, Kelly. What's up?
About 12 years ago, me and my husband purchased a universal life insurance policy to help pay for my son who's going to college in 2 years. And I'm concerned about the amount that we contribute every month and if we're going to have enough to pay for school. And also, was it a good investment since it's not an insured account?
How long have you been watching the Susie Orman Show?
A while.
A while, and how many times? How many times have you heard me say I hate universal life in the majority of the cases?
Yes.
A lot. All right. Let's just let the numbers speak for themselves, girlfriend. Okay? You put in how much per month?
Total 463.
A month?
Yes.
All right, so just let's say it's $400 a month. We'll make it easy for the math. That's $4,800 a year, correct?
Yes.
So over 10 years, that's $48,000. How long have you been doing this for?
Probably about 12 years.
So $58,000. Let's just say $60,000 in there. You put $60,000 in there. What is the cash value of the policy today? Not the accumulated value, the cash value when you start to withdraw it.
About 40,000.
All right. Is that a good investment? You put in $60,000 and you're going to take it out. You have $40,000. You have lost $20,000. And really, that was, you put in $60,000 with no interest whatsoever, so to speak. So was it a good investment? It was a horrific investment. I'm going to say this once. I'm going to say it for the rest of my life. Here's what you have to get. Insurance needs to be insurance. Investments need to be investments. You should never combine the two. Ever, ever, ever. With that said, you are far better off at this point in time now taking the money, paying for your son's college education, and stopping the policy really at this point in time and taking that, $460 some odd dollars a month every month and putting it right towards his college education. Now that he's older, there's not a lot of catch up to be, but that could have been at least probably $100,000 if we had done it correctly. Just so you know. I just have to address Kelly's call that she just said for 12 years she's been putting money into this universal life insurance policy. Really, she should have $80,000, $100,000 in there, and she has, 40? Here's what I want you to understand. Do you think when I sit here and I'm talking about how in most cases I don't like universal, variable, or whole life insurance that I'm not talking to you? I am talking to you, but you don't have to believe me. Just do me a favor. If you have one of those policies and you purchased one of those policies as an investment, it's a great way to invest your money as well as provide yourself with insurance. Don't take my word for it. Get out your paperwork. Look at how much money you have invested. And do me a favor. Go to one of those compound calculators that happen to be online. And start with, you put in $460 a month, and you did so every single month for 12 years. Even at just 4%, what would that be? That'd be like $85,000. So do your own numbers, and then take a look at what your cash value is, not the accumulated value, because that means nothing. What would you get if you cashed it out? And you will see that you have probably 50% less than you should have had if you just invested that money at a simple 4% annual average rate of return, which isn't that great. People got it? So can you just really check it out and stop wasting money? Hey, Lindsay, let's go to Kelly.
Okay. All right, that's enough of that, and enough to be beating the dead horse. So it's obviously that it's bad. Okay. When an insurance agent, and you can ask them by law, are you are you securities licensed? Are you investment licensed? If they say no and they're talking about savings, tell them, hey, do an about face, which in military means turn around 180 and walk that way. Okay? They don't have your best interest at heart. That's okay. All right. The other things the other thing you need to learn is that you're gonna find that a lot of people only have insurance through work. So my saying when it comes to this is always this: if it's free or if it's cheap, great, keep it. Okay. But you should never pay into this. You should never, first of all, you should never count on this as rely on this, okay, on this type of policy. And I'm finding that a lot of people are paying for this. Okay. All right, so let me cover why you don't want to have rely on insurance through work, right? Number one is you don't own it, okay? Your employer does. So here is my thought of that. If you look at the news, if you hear from people, what's the trend? Are companies increasing benefits, giving you more free benefits, making things? Are they doing that? They're removing it. They're reducing it. Anything that they give you reduces. Business 101. Oh shoot, revenue minus expenses equals profit. Okay. Anything they give you falls into an expense to them, meaning that they make less money, less profits, right? So what are they doing? Or what can they do at any point? They can reduce it, they can cancel it, or they can change the terms at any point because they own it. You have no ownership. Okay. The only time you have you own a policy is when you have a contract in your hand. Go to your employer, ask them to give you a copy of your life insurance policy. They're gonna be like, you don't have that. They might give you a certificate to tell you that you're insured, but that's not a contract. Okay. So that's the number one reason, or reason number one. Reason number two is coverage ends if you quit. So if you're no longer working there, or they're no longer working with you, all right, if they let you go, you get fired, you're no longer protected. You no longer have insurance. Okay. Or if you're not actively working there, and I'll explain what that means. So someone, generally speaking, what usually happens to most people, unless they die abruptly, right? They get sick first and then they die. And when you get sick, you can't go to work. So that means you're not actively at work. And if you pass away, you're not covered. Okay. Third reason is because it only usually covers 1 to 2 times your annual salary, which we know we need 10 times your annual salary. All right. It's almost it's never enough. Okay. A couple other things is that you cannot customize it. Again, this is not a personal policy, so it doesn't have additional riders. Okay. And I've seen policies where you can buy at an extra cost, buy additional riders, but they're usually expensive. Okay. So some of the riders, which you're gonna learn, you're gonna learn a little bit. I'll cover them when we're talking about what we offer, right? The increasing benefit rider, which is our policies, Primerica's policies come with an increasing benefit rider, which is a protection for your against inflation. Bethany, go ahead. Question. You're the birthday girl. You can say what you want.
No. So I was looking at mine a while back for work, and ours goes by our age. So if you hit a certain age, it's lower for the older you get.
The coverage, they drop the coverage?
Yep.
Okay. Yeah, it makes sense because again, it's kind of like a decrease in term where you're getting older, you're paying the same. So it's becoming more expensive for them, so they have to drop the coverage. So yeah. So increasing benefit rider is, okay, so let's say you need $100,000 in coverage today. Well, in 10 years, those $100,000 is not going to buy you the same thing. You need more to buy the same thing. So our policies come with protection against the inflation. And what they do every year, they give you a little bit more coverage at the same age and health when you get started, regardless of how, what happens to you later, for a little bit of a small premium increase. Okay, and it's automatic. But that's an amazing thing. They don't have waiver of premium. That's important. Waiver of premium is important because we don't know what's going to happen. So in the event that we cannot work, let's say we get sick, and we cannot work, we're not bringing enough income to pay for the policies. Well, the waiver of premium rider kicks in and it maintains your policy active. No terminal illness. Okay, so our policies come, God forbid something happens to you that you are deemed terminal, you have an illness that's going to terminate you within 6 months. You can take some of your the death benefit out as a form of a cash, not a loan. It's basically you're accelerating the death benefit. You get it ahead of time, okay, and you can use it for whatever reasons. There is no meaningful, and I say meaningful, spouse or child rider because they usually cover very minimum at a higher cost. Okay. The other thing is too little, too late. Okay. I always like to put this there to explain this. When people are working, they think they have that. Well, you're getting older, unhealthier, right? Your body's not getting healthier. So when you leave your job, you're going to be older and possibly in worse health, making new coverage a lot more expensive or at a risk of not being covered, okay? Not being covered, all right? Now, I said earlier that I talked about this part right here, actively at work. I have an example of a letter that we received, right, from a lady whose husband died. And this is what the company says. So we have reviewed your claim for the life insurance benefits on their policy and regret to inform you that no benefits are payable. Please let me explain. Okay. They're going to the finish. So basically what they're saying here, actively at work, right? Actively working. Active work means an employee is performing their normal duty, the normal duties of his or her regular job for the policyholder on a regular and continuous basis of 40 or more hours a week. So here's an example. Let's say you no longer have health, what is it called? Medical leave or medical time off? I don't know the term. Anyway, if you cannot be
LOA, leave of absence.
okay, if you cannot be absent because of medical and you miss 1 hour of work, so you only work 39 hours, now you're not covered. And they go further here. So, and they actually went into the details. Hey, he got hospitalized on October 27th, and he died November 6th, blah, blah, blah. All of this crap, okay? Yeah, so the point is, guys, you should never rely on group insurance because it's not yours. It covers you in certain situations. You should have 100% of what you need personally, and that it covers you regardless. All right, and the last type of policies that we're going to cover is term life insurance. So you will see policies from other places, okay? But here is the thing: if it's not from Primerica, it's never a good policy. Because again, all of those companies, they sell other products. They sell cash value products. And a good strategy, this is what I'm seeing right now, they'll put you in a term first to get you to convert later to cash value. Okay. So there's 3 types of term policies. Okay. You guys learn about ART, which is death benefit stays level, but the premium goes up. You guys learn about decreasing term, where the premium stays level, but the death benefit drops. and you've also learned about level, which is what we offer in Primerica. The premium stays the same, the death benefit stays the same. Okay, you should always get level. There are certain situations where a decreasing term might be a good fit, like an older person. If a person they're above certain age and they just want to keep insurance, I'm I'm gonna tell them, hey, why don't we just put you in the decreasing term? Because it doesn't make sense that you're paying so much money for a policy in your later years when you have no one depends on your income. Most likely they need it for funeral expenses and burials and things like that. So decreasing term might be the most beneficial there. Okay. Now at the end of the terms, this is something to learn. When you have a policy with a term, at the end of the term, they all have the same thing. You have three options. You can either renew it, in other words, you're gonna keep the term, you're gonna go from a term into another term. So you're gonna renew the policy. You're gonna convert it from a term into a cash value policy, or you're gonna reapply, meaning that you're gonna drop that insurance and just reapply for new insurance. Well, reapplication is never good because now you're a lot older, a lot unhealthier, right? So the cost of insurance is going to be crazy. It's going to be crazy anyway. Okay, that's why it's so important that you do what we tell you to do, which is have insurance and have investments at the same time. If you only have one, at the end of term, you're going to be in a difficult situation because you're still going to need insurance because you didn't save, and now the insurance is going to be costly. Okay, so here's an example of a renewal and why any other term is bad. Okay. All right. So here's I took this from a policy. All right. I took a snapshot from a policy. This client, this person here was gonna go from $935 a year, which is $77.91. By the way, this is a term policy from USA for my military members. We think that USA is the best for all of us, but they're not. They're a business. They want to make money. And it was going to go from $935 a year to $56,000 a year. Shoot, who's going to be able to afford that? It's going to go from 77 to 4,700 a month. Super unaffordable. So what ended up happening is the person just has to drop and be without insurance. Okay. The second part is the conversion. So all policies are the same. All term insurance are the same when it's not with Primerica. Primerica is the only company that only sells term insurance. We don't sell anything other than term insurance. So you're gonna see there in the conversion section of the policy of the contract, it will say the new policy may not be a term, or in some cases they might say something like it can only be converted to a permanent life insurance plan, aka cash value. Okay. Also, it requires new proof of insurability. Okay, so you're gonna have to undergo medical underwriting. So what happens when we go through medical? I mean, let's say 20 years has passed. We're older. Now we might have high blood pressure. What is it called? Fatty liver. All of those things that we get as we age, right? We're a little bit chunkier. You know, we're not as slender as we used to be, so we're a little bit overweight. You know, our health is not the same, so it's just gonna make it impossible for someone to keep this policy. Okay. All right. So that being said, let's go over Primerica term. All right. Just so you understand that our policies they're not all term insurance outside of America. They're what we call a naked policy. That you get a policy and that's it. Our policies come with a lot of benefits, and that's what you need to understand. So not only that I'm teaching you this so you learn, but you need to internalize it. So because when you're confident about what you're offering, okay, you know that what you're doing is good for people. So you cannot you're as you gain confidence, you become more competent. Okay. So Primerica terms benefits. Okay. The first thing is affordable renewable rates. If at the end of the term, I always tell my clients, we have to make sure that that you're financially independent by then, because otherwise you're going to need another term. But even if that happens, the renewal rates are a lot affordable. They're a lot lower. They're going to be more expensive than when they got started. Obviously, they're older, but they're affordable. Second benefit is that they get a representative. All right, they don't get a life insurance agent. They get someone who, or we're gonna give them personalized solutions. Okay, we're here to help you with all your needs, not just to give you life insurance. They're gonna get a complimentary F&A, which is the game plan. All right, if you don't know exactly what to do, if you don't know the rules of a game, how can you win in a game? Okay, the financial needs analysis is going to show you the target. Okay, so now when you throw the arrows, you know where you're aiming at, versus how most people are doing. They're just shooting arrows hoping they'll hit the target. No wonder why 95% of Americans never make it. They retire broke. Once you're insured with us, you're guaranteed insurance all the way to 95. Meaning if your health changes, if you get cancer or whatever illness you get that no company will insure you, you're guaranteed insurance regardless. You don't no longer have to go through medical underwriting again. All right. We are the only company that offers terms up to 35 years long. All companies do 30 and under, but you will find that a lot of when they sell a term, they usually do it for lower terms, 10-year, 5-year term, because they want to get you in. Oh, here's what it says in the policy: you must convert to a cash value, and they'll get you converted later. They're very smart. They're very savvy. All right, our policies offer child riders. So for the cost of one child, a family can insure all insurable kids, meaning step kids. What is it called when you adopt the kids, grandkids, all your kids, unlimited for the cost of one. All right. I mentioned the increasing benefit rider earlier, which is the protection against the inflation. Terminal illness, I talked about this earlier. This is a big one. Our policies don't have any exclusion, no war or terror exclusion. I'll give you an example. Everyone that died during 9/11, with the exception of Primerica, their policies, the death claims were denied because it was a war. It was considered a terror attack. All of those people that died in that Vegas shooting that happened many years ago in a country music concert, the death benefits got canceled. And I actually have a story about that, but I'll tell you another time. We're running out of time. I talked about waiver of premium. 91% of our claims are paid within 14 days, and we have a convenient digital experience. So everything we have a system where you access your system. You're going to see your policy, your investment, everything will be all within one place. Okay. All right. So that's life insurance 101. Was that a good thing? You guys learned something?
It was great detail, Coach. Appreciate it.
Good.
Yeah, it was very informative. I did learn some things.
Good deal. Yeah. So here's the thing: nobody's gonna take advantage of you. Okay. And when it comes to life insurance, nobody can take advantage of you no more. All right. So yeah. So let's go out there. Let's use our licenses. For us that are not licensed yet, let's do what we have to do to get our licenses. And yeah, so with that, we can go out there, we can help a lot of people, we can make a lot of money in term, okay, which goes hand in hand. Okay, if you don't help nobody, you don't make no money. Win-win situation. We help people, we make money. Okay, it's only fair. So yeah, that's all I have for you guys today. Thank you for showing up. And again, Bethany, happy birthday. And for you ladies, tomorrow's tomorrow's Mother's Day, which every day should be celebrated. Every day should be celebrated, but especially tomorrow. Happy Mother's Day. And I hope you guys enjoy your weekend.
Happy birthday again, Bethany. Happy Mother's Day, ladies.
Bye. See you guys
Thank you. Have a good day, guys.
All right.
Thanks, Coach.
All right. Talk to you later. Thanks, man.